Options and futures are sophisticated financial instruments that provide investors with unique opportunities for risk management, speculation, and portfolio optimization. This article delves into advanced strategies for sophisticated investors, focusing on the intricate world of options and futures trading. We will explore the definition and characteristics of options and futures, examine their benefits and risks, and delve into various advanced strategies employed by experienced investors to enhance their investment portfolios. Understanding options. 1.1 Definition and types. Explaining the concept of options as financial derivatives that grant the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified time frame. Differentiating between call and put options. 1.2 Option pricing. Discussing the factors that influence the pricing of options, such as the underlying asset's price, volatility, time to expiration, and interest rates. Introducing the concept of intrinsic value and time value. 1.3 Option strategies for income generation. Exploring advanced option strategies, such as covered calls, cash-secured puts, and iron condors, that aim to generate income through options trading while managing risk. 1.4 Option strategies for speculation. Investigating strategies like long straddles, long strangles, and butterfly spreads, which allow investors to speculate on significant price movements in the underlying asset. 2. Exploring futures contracts. 2.1 Definition and mechanics. Defining futures contracts as standardized agreements to buy or sell an underlying asset at a predetermined price and date. Explaining the margin requirements, daily settlement, and contract specifications. 2.2 Benefits and risks of futures trading. Discussing the advantages of futures trading, including leverage, liquidity, and risk management capabilities, as well as the associated risks, such as price volatility and margin calls. 2.3 Hedging with futures. Examining how sophisticated investors utilize futures contracts to hedge against potential adverse price movements in their existing portfolios or underlying assets. 2.4 Speculative strategies with futures. Introducing advanced strategies like calendar spreads, intercommodity spreads, and volatility trading that allow investors to speculate on price differentials, market relationships, and price volatility. 3. Advanced option strategies. 3.1 Vertical spreads. Exploring strategies like bull call spreads, bear put spreads, and ratio spreads that involve buying and selling options with different strike prices to create defined risk and reward profiles. 3.2 Diagonal spreads. Discussing strategies such as diagonal call spreads and diagonal put spreads that involve combining different expiration dates and strike prices to capture both time decay and directional movements. 3.3 Butterfly spreads. Examining strategies like iron butterflies and broken wing butterflies that involve combining multiple options to create profit zones centered around a specific strike price. 3.4 Synthetic positions. Investigating synthetic options positions, such as synthetic long, short stock and synthetic straddles, strangles, which replicate the risk-reward profiles of certain positions using combinations of options and underlying assets. 3.5 Option combinations. Discussing more complex strategies like collars, reverse collars, and risk reversals that involve combining options with different strike prices and expiration dates to manage risk and capture specific market scenarios. IV. Advanced futures strategies. 4.1 Spread trading. Exploring strategies like calendar spreads, intermarket spreads, and crack spreads that involve taking positions in multiple futures contracts to capture price differentials or market relationships. 4.2 Commodity spreads. Discussing strategies that focus on the price relationships between related commodities, such as bull and bear spreads, crush spreads, and spark spreads. 4.3 Volatility trading. Investigating strategies that take advantage of volatility, such as straddle, strangle spreads, volatility arbitrage, and volatility futures, to profit from price fluctuations and changes in market expectations. 4.4 Trend following. Exploring strategies like moving average crossovers and trendline trading that aim to capture sustained price trends in futures markets by identifying and capitalizing on price momentum. versus risk management and considerations. 5.1 Understanding leverage. Discussing the impact of leverage in options and futures trading, emphasizing the importance of risk management, and utilizing appropriate position sizing and stop-loss orders.